Let me be brutally direct with you right now, because what I am about to tell you is something that the overwhelming majority of financial commentators on this platform do not have the courage to say clearly. The stock market is about to do something that most investors have never seen in their lifetime. Not a correction, not a pullback, not a healthy consolidation. Something structurally different from anything that has happened in the last 15 years. And the reason most people are going to be completely blindsided by it is not because the warning signs are hidden. It is because they have been staring at those warning signs every single day and telling themselves it cannot happen because it has not happened yet. I am going to give you a specific number in about 90 seconds that tells you exactly how close we are to the moment most investors are not prepared for. Stay with me, because this number changes everything about how you should be thinking about your portfolio right now. Subscribe to this channel right now, not at the end. Now, what I am handing you in this video is the kind of structural equity market analysis that Ray Dalio's Bridgewater Associates produces for the sovereign wealth funds and pension managers who pay millions of dollars per year for access to it. I am giving it to you here for free. One click, subscribe, and then do not move. Here is the number, 40%. The top 7 stocks in the S&P 500 right now represent 40% of the entire index by market capitalization. 40%, 10 companies out of 500. That is the highest concentration in the index since 1972. And the last time concentration was this extreme, we were 18 months away from a decade of negative real returns for passive investors. But here is what makes 2026 categorically more dangerous than 1972. In 1972, the concentration was in industrial conglomerates and consumer staples companies with real earnings and real assets. The concentration today is in 7 technology companies whose current valuations are priced for an artificial intelligence future that has not arrived yet. And the gap between what those valuations are pricing in and what the economic reality is delivering is the most important financial fact that most retail investors are not looking at honestly right now. I am going to show you exactly what that gap looks like in real numbers in 2 minutes. But first, I need you to answer a question honestly. Are you the kind of investor who looks at a market that keeps going up and concludes that everything is fine? Or are you the kind of investor who asks why it keeps going up and whether the forces driving it can continue? Because those 2 questions lead to completely different portfolios. And right now, in May 2026, the answer to that second question is the most important financial analysis you can do. Stay with me, because this is where it gets specific. The S&P 500 has delivered approximately 3 consecutive years of double-digit returns. Most retail investors look at that and feel reassured. Ray Dalio looks at that and sees something completely different. He sees a market that is being mechanically supported by 4 structural forces that are each showing visible signs of strain simultaneously. And when all 4 strain at the same time, the thing that has been holding the market up does not bend. It breaks. Here is what those 4 forces are, and exactly where each one is showing strain right now. The first force is the passive money machine. 60% of all U.S. equity investment is now in passive index funds. Every paycheck cycle, billions of dollars flow automatically into those funds, which automatically buy the biggest stocks, which drives up the prices of the biggest stocks, which makes them a bigger percentage of the index, which means the next contribution buys even more of them. It is a self-reinforcing flywheel that has run for 15 years without interruption. But the kill switch on this flywheel is unemployment. When a recession hits and people stop contributing to their 401k accounts, the mechanical buying pressure that has held this market up reverses, and the 40% of the index that is concentrated in 7 stocks gets repriced violently as the passive buying pressure that inflated those valuations disappears. The second force is the Fed put. For 15 years, every time the market fell significantly, the Federal Reserve cut rates and the market recovered. Investors learned that lesson and never forgot it. But the Fed put has a kill switch too. If inflation is running hot, the Fed cannot cut rates to save the stock market without accelerating the inflation that is already destroying purchasing power. Right now, Dalio said publicly this week that we are already in a stagflationary period. That is not a prediction. That is a present tense assessment from the man with the most accurate macro forecasting track record alive. Stagflation is exactly the environment where the Fed put stops working. The third force is algorithmic trading. More than 60% of daily market volume is now controlled by systems that follow price momentum mechanically. When prices trend up, they buy. When prices trend down, they sell. These systems have provided a mechanical floor under the market during every sell-off for the last decade, but they cannot create buyers that do not exist. When the fundamental buyers, the passive contributors, and the Fed put believers stop buying, the algorithms have nothing to follow, and momentum to the downside accelerates as fast as momentum to the upside did. The fourth force is the AI valuation premium. The 7 stocks representing 40% of the S&P 500 are trading at valuations that price in AI, delivering economy-wide productivity gains within a very specific and very near-term window. Dalio said publicly this month that we are definitely in a bubble. Not possibly. Definitely. And then he said something that most people missed. He said, but it does not mean you should sell yet. Think about what that sentence actually means. The man who manages $124 billion is telling you the bubble is real and confirmed. And that timing the exit is what separates the investors who profit from the ones who get hurt. Now here is the question I asked you to hold at the beginning of this video. I am going to give you the answer now with data. What is about to happen to stocks that most investors have never seen in their lifetime? The answer is not a crash in the traditional sense. It is something more insidious and more damaging than a crash, because it is harder to see coming and harder to protect against. It is a repricing, a slow, grinding, sustained compression of the valuations of the 7 stocks that represent 40% of the index as the AI narrative hits its first visible wall. And when those 7 stocks compress, the passive investors who thought they owned 500 companies discover they were concentrated in 7 the entire time. The people who held the S&P 500 through the Nasdaq's 50% decline in the dot-com bust were not in a diversified portfolio. They were concentrated in technology stocks through a diversification label. The same thing is happening right now at an even more extreme concentration level. Here is what the historical data tells you about what comes next with documented precision. Every major technology valuation bubble in the last 100 years has followed the same sequence without a single exception. Initial enthusiasm drives valuations above any reasonable fundamental justification. A period of sustained price appreciation creates the consensus that the technology is different and the old valuation rules no longer apply. A visible event, not necessarily dramatic, sometimes as simple as a disappointing earnings report from one key company, causes the first crack in the narrative. The crack spreads because the valuation premium was built entirely on the narrative.